Chris, thanks very much, not just for the introduction, but also for organizing this event. It's great to be here. Good morning, everyone. Sorry I can't do this in Italian, French, or German. Fortunately, English has sort of become the language that connects everybody. So, yes, there's a book. It came out in March, The Future of Pension Management. Delighted to, once you're an author and you get a book out, you really want to come out and talk about it. So this is a wonderful opportunity to do that in Switzerland. So what I intend to do is actually also not go for 45 minutes. That's too long. I find that after 20, 25 minutes, people want to get a little edgy. And so we'll put the panel on. They will have some comments on what I say. And then we'll open up the floor and hopefully have a good conversation about the future of pension management. So the plan is I'd like to just back up a little bit and give you the context for how this book got to be written. Then I'll tell you a little bit about what I think the key messages are in the book. And then we'll open it up for discussion with the panel and with all of you. So, how far to roll back the clock? And I'll just say, well, a few decades. Once upon a time, I was a PhD candidate at McGill University in Montreal in economics. And I got about halfway through the program and sort of hit a conceptual wall, which I think had to do with the fact that once you study some of the basics in economics, after a while, you just make it up. And I thought, well, I can make it up as well as anybody, and I don't really need a PhD or to write a thesis to prove that I'm an economist. And fortunately, I had a friend who rescued me from academia, Bob Swan, who said, we'd gone through a master's degree together, but he joined Sun Life in Montreal in the investment department. And he said, well, if you're done with academics, come and work with us in the investment department of Sun Life. And I was very happy to do that. And so what was my first assignment? Well, my first assignment, if you roll back your clocks, most of you in the CFA world know enough about the history of sort of finance theory, investment theory, to know that in the late 60s, it was a rather formative time because people who were unknown at the time with names like Harry Markowitz, Bill Sharp, et cetera, were writing articles and theses of new ways to think about investing. And Sun Life, in its wisdom, decided to give me an assignment to go and meet these people, read their stuff, and see whether it had any practical application to running an investment department. And that turned out to be a very formative early assignment because I got to see both the theory side as well as the practical operation of what happened in the equity department, the bond department, the mortgage department, the real estate department, currencies. There was a different floor where all the actuaries lived, and I even got to visit actuaries and see what they were up to. And it was sort of an interesting sense that they were on a different floor, and there was no integration at that time, it seemed to me very much, between what actuaries did and what investment people did. And that was sort of one of my first ahas, that maybe some integration would be a good thing. The other thing that happened as I wandered through the halls of the first big organization generally I'd ever been involved with was the notion and the idea of, well, how do large organizations operate? What makes them effective? And that got me into a whole strain that actually, in terms of the academia in economics, never got mentioned, which was the importance of the organizational effectiveness of an organization in terms of how well it achieves its mission. Fortunately, a man called Peter Drucker, how many people here know the name Peter Drucker? There we go. I don't need to do a lot of explanation. Long established as the father of modern management theory and application. And over the course of his very productive life, he would write 39 books. I'm only on number 4. Now, he did live till he was 96, so he actually stretched it out quite a long way, and he kept writing, he kept being productive. Well, it turned out that one of the 39 books was on the future of pensions. And he wrote it came out in 1976. Think about that, 1976. And it was called The Unseen Revolution. And the notion of the book was unseen in the sense that other than Drucker, very few people had thought about the implication of the demographics. You think about the baby boomers in the 1970s, they were young people at that time, right? But Drucker, in his forward-looking sense, said, well, you know, someday they'll all retire. And that whole process will change a lot of things. And the specific 3 things that he wrote about in this book, this evolution of demographics and then the retirement savings boom, he raised 3 questions. He said, 1, in whose interest will all this money be managed? And when you look around the circle, it wasn't really obvious. You know, would it be managed in the interest of the beneficiaries, in the interest of the corporations that would be largely the sponsors of these plans, governments perhaps, labor unions? And he posed the question of that needed to be sorted out in terms of whose interest would the assets be managed. And then the second thing was the organizational implications of all this retirement money out there. What kind of organizations would be required to actually manage these money and deliver the pensions? So that was the second question. And then the third question was around investing. How would this large pool of retirement savings be invested? Using what principles? Well, that struck me as immediately 3 very weighty questions that I've spent the rest of my professional life thus far thinking about, doing research on, and trying to answer. First thing was to actually, once I moved on to the bigger picture stuff, actually I worked with some friends. We formed a firm called PFA, Pension Finance Associates, and it was really sort of the Drucker view of pensions and the implications of the organizational implications of that. And then I'll just do very quickly what it led to the first book in 1985, Pension Funds and the Bottom Line. I co-founded something called CEM, benchmarking, and it's another Druckerism. You know, one of the Druckerisms is what gets measured gets managed. What gets measured gets managed. Well, I looked around the pensions world and we weren't measuring the right things. I mean, ultimately, it's always about value for money. Right? How much money are you spending? What kind of value are you getting? Well, there was nothing in the pensions world that I could see that tried to answer those questions, both on the investment side and on the benefit administration side. And so CM benchmarking was put into place to actually answer those questions. Happy to say that today, 25 years later, it has become the global standard in terms of value for money measurement around the world in pension organizations. Don Ezra, a friend and partner of mine in PFA, we ended up going together writing Pension Fund Excellence in 1987, and it was around this notion of organizational effectiveness, governance, and those kinds of things. I started up something called ICPM, International Center for Pension Management, which was this notion of getting large pension funds around the world, the thought leaders, to come together on a regular basis to think about how to be better organizations, how to be more effective in delivering the services. And then finally, we get to, very quickly, we get to today. The other thing I'll mention is that an outgrowth of ICPM and through the Rotman School of Management, it was clear that there was a need for board member education. This whole notion of, if you're going to be a board member of a pension organization, what kind of responsibilities are you taking on? And how are they best discharged over time? So we created a program called BEP, Board Effectiveness Measurement, or not the measurement, but the actual management of these boards. And we've done the program 8 times now. It's been very successful. The 9th one will go in another month or so. So that's another dimension. And then we get to today, which is the book number 4, future pension management. I'm going to do just a 30-second segue here, which is one of these things. If you remember nothing else about this session, remember this. And it's about the rule of three. And it turns out, and I learned this from David Beatty, a colleague at the Rotman School, is that if you want to be an effective deliverer of a message, you should keep the rule of three in mind. And because it will make your message concise, compelling, and memorable. So as we go through this thing, you'll see me using it a few times, and I hope you say, aha, there's the rule of three again. It really is effective, because I remember what was just said. So pay attention. So, of course, the book has three messages. And it relates to the design of pension organizations. It relates to, or the design of pension systems, then the design of pension organizations, and then the investing of pension assets. So the three things that are covered. And the key word in this is integrated, because you can't think of these as three separate discussions that don't relate to one another. They do. And so part of the connection, what are the connections between those three discussions is another part of the organization. So my job here is to assert, or to convince you that these three assertions are true, and then we'll explore the implications of that for Switzerland, pension system, your organizations as you as individuals. So that's the plan, and let's see if I can find the clicker here somewhere. Here it is, and see if it works. Okay, here we go. So the first discussion is about pension design. And I can get it on one picture, as you can see. Our help here is from the World Bank. They put out a paper in 1994, so this was early on, relatively early on, not as early as Drucker, but early, 1994. Averting the Old Age Crisis was the name of the paper. And what they suggested is that it would be helpful if we thought, we had discussions about the design of retirement income system, so RAS is retirement income system, in the fact that there are how many? Three dimensions to retirement income systems, and they relate to this notion of a universal pillar one, typically pay-go funded, and then a pillar two, workplace-based pensions, and pillar three, the do-it-yourself part of pension systems, where there may be some tax incentives to save for retirement yourself. And it's a very strong, powerful way to actually have some discussions. I use it in the book. And the two key things that, because you can write books, many books about the design of retirement income systems. There's two things that I focus on in the book that we need to think about how to do better. One of them relates to Pillar 3. And the problem with Pillar 3, and then I start bringing in various Nobel Prize winners to help me make the point. One of them is George Akerlof, who was awarded a Nobel Prize in economics 1981, I think, for the notion that for markets to properly work, you need symmetric information between buyers and sellers. In other words, you need a level informational playing field to get good outcomes in terms of pricing, resource allocation, et cetera, et cetera. And then he posed the question is, well, what, if the market doesn't have that characteristics of asymmetric or symmetric information, what happens? Well, you get asymmetric outcomes, is what he argued. And if sellers know more about what they're selling than buyers know about what they're buying, guess what? The sellers win. They get to charge too much for delivering too little value. And in my view, there's no larger market in the world that suffers from asymmetric information than the global market for financial services. And that is the rationale for having that Pillar 3 as small as possible, because it's very easy for individuals to be picked off by the financial services industry one at a time. Where in Pillar 2, you get much more of a collective approach to the design of retirement systems and more of an opportunity of having a level informational playing field. So that's one of the key messages in the book, is make Pillar 3 as small as possible. And of course, just as a footnote, in Switzerland, as soon as you have compulsory participation in Pillar 2, I mean, you have a large policy piece that takes care of that problem. A lot of other countries don't have that requirement, and their Pillar 3, Canada, for example, is too large. So that's one thing. The other thing that I spent a lot of time and effort on the pension design question is the design of workplace pension plans. And then here I bring in another Nobel Prize winner, the first one, a Dutch guy, Jan Tinbergen, and his claim to fame was that you need as many instruments as you have goals in economics. So he related it more at a macro level to employment, inflation, et cetera. But well, I stole that idea and applied it to the design of workplace pension plans. And I have been arguing for over 10 years now that when you look at the economics of workplace pension plans, there are two things going on. There are two important dimensions to keep in mind. You know, given a target pension, one relates to this notion of, let me see where I am here now, of the two goals, once you have the target pension, one relates to adequacy, another one relates to the notion of affordability, and the third relates to safety. In other words, as a pensioner, you want to be paid whatever the target pension is. You want your check every month. If you're a young worker, what's the big thing that you want? You want affordability. And what drives affordability in a pension system? Compound return over a long period of time. A rule of thumb is, at least historically, that in funded pension plans, something like 70–80% of the resources that come from paying the pension come from the returns on the retirement savings, which then makes the contribution rate required lower, right? So for young workers, the key thing is compound return over a long period of time. For retirees, the goal is to get the check every month. So how many goals is that? It's not three, actually. It's only two goals. So what would Tinbergen say about a situation where you have two goals? You need two instruments. What do we do with our either DB or DC plans? We're trying to do two things with one instrument. And that's the fundamental flaw in workplace pension plans, is that we need to move away both from the pure DB plans and the pure DC plans towards a more integrated view of taking care of both the affordability side and the safety side, which requires two instruments through which workers move from one goal, affordability, to eventually, as a retiree, the goal of safety. So that's the other key message then on the design side of the book. Another dimension here that I'll just quickly throw in is that our friends in Australia, about 10 years ago now, decided that it would make sense, again in the context of what gets measured gets managed, is to start measuring the quality of retirement income systems. It's by no means perfect, but I think it provides a good indication of relatively where a country's retirement income system stands in relation to other countries. So the last time they did this last year, they'll be coming out shortly with their new rankings for this year, and they've been adding countries every year. Last year they had 25 countries. This year they'll have 27. And so what did they use then as criteria for judging the quality of a country's retirement income system? Well, guess what? It's three things. It's about adequacy. Does the system produce a reasonable shot at people being able to maintain their standard of living post-work? Second one is sustainability. If you have a wonderful system that's producing a lot of pensions today, question is, will it still do that 10 years from now and 20 years from now and 30 years from now? Is the system sustainable? So that's the second area that you get marked in. And then the third area is integrity, the notion of, is the system well put together? Does it produce value for money? And so you can see Switzerland's ranking here, not bad. Didn't quite get either the gold, silver, or bronze medal, but close. And then the other thing that happens, the way that it's done is actually the Mercer organization globally does a lot of the groundwork in the different countries, and they bring it together, and then they come up with some recommendations for each countries of how to move up in the rankings. And you can see these are the Mercer Melbourne recommendations for Switzerland in terms of some of the things that you could do here to get up from number 5 to number 4, number 3. Who knows? So we can talk about those recommendations in the discussion period. So that's enough for pension design. Let's move on to the next question, which is the Drucker model of how to think about pension organizations. And of course, now you'll start to recognize the three again. His arguments are around three things. One is the mission of the pension organization clear, clarity of mission. The second one is around organization design and governance. Is it effective? And then the third area that turns out to be tremendously important is, does the organization have the necessary resources in order for it to carry out its mission? So it's a resource question. And so I've been looking at those three criteria now for multiple decades. And my sense is that, on average, pension organizations globally need work in all three areas to get better. And just to give you a brief sense of what I mean by that is, the mission of the organization, for example, clarity. And I argue that for many organizations, it's not that clear. And as one example is this notion of, one would think that a organizational mission should be to achieve fairness between different generations, so that the system doesn't advantage one generation at the expense of another generation. Well, there are many systems around the world today that don't meet that test. So we have work to do in the missions area. With respect to governance, again, if you look at the historical evolution of governance in pension organizations, it's been very ad hoc. I mean, there hasn't been some overall Drucker principles that were used to put together boards of pension organizations. It's been much more ad hoc. And what's typically driven the selection process for board members is representativeness. Well, the union's involved, so we must have some union people. There's a sponsor, maybe it's a corporation, so we need some corporate people. And then maybe we need some group to look after the retirees. And so you look around and you have a representative board, but if you don't have a quality overlay, which is to ask the question of, is this board collectively in a position to oversee what is effectively a complex financial institution? Can they ask the right questions? The answer in many cases is no. They don't score all that well in terms of competence and effectiveness. And then the question is, what do we do about that? And again, we can talk about that in our discussion. There are, I think, things that you can do to raise the quality of boards without losing this notion of representativeness. And then the resource constraints. Question. Really a very big issue. And talking to Chris, that includes Switzerland. One is the notion, maybe the most important one, is the notion of scale. And when you look at the economics of pension organizations in terms of the investment programs, in terms of benefit administration, scale is tremendously important. Through CEM benchmarking, the benchmarking organization, we can actually measure the economies of scale that go along with whether you're a $1 million pension fund or a 10 billion, let's make it billions, 1 billion, 10 billion, 100 billion. You can actually measure, because the database is large enough, what happens with scale in terms of unit costs, both on the investment side and on the benefit administration side. The other thing that starts to happen with scale is that if you're big enough, you can start insourcing. And again, the logic and the numbers show that insourcing, if you're large, is a tremendous cost saver. And at the same time, generally speaking, the larger you are, the more opportunity you have, if you like, to create boards that truly understand the nature of the business and can oversee value for money and the strategy for achieving it. So the other thing I'll just mention in terms of the scale thing is that if you're small, by design, pretty well, you're forced to outsource. So you outsource your investment, you outsource other kinds of things, economic analysis, policy decisions, and you're creating an extra layer of agents. And the more agents you have in the system, Drucker would say, the less likely it becomes that you can get value for money. Maybe a somewhat controversial statement, but we can just pick that up in the discussion. So I had a chance in the 1980s to actually put the Drucker model to a test, which led to a report in Ontario to actually create Drucker-type pension organizations. The recommendation was picked up by the Ontario government and the Ontario Teachers Federation, which led to the creation of Ontario Teachers Pension Plan, which, if you follow it through its 25-year life since 1991, has operated as a Drucker pension organization now for 25 years. And the results, in fact, show that if you can actually implement the model, you create tremendous value for stakeholders. On the investment side, for example, it's generated an extra 220 basis points per year over the market. On the benefit administration side, it produces more value per dollar than anybody else, the other 90 funds that do that kind of measurement. So it works. So I'll leave you with that one, that thought on organization design issues. And then finally, we'll have a look at the investment side. I'll throw in Einstein here, Albert Einstein. He deserves some place in this. The line that I use from Einstein is make things as simple as possible, but no simpler. Think about that. It's an extremely powerful idea because we as humans tend to make things complex. When we change our mind, we tend not to get rid of the old, we just add another piece. And then eventually complexity takes over. And I certainly see that happen in pension systems. So keep things as simple as possible. So what's important here? And returns. So let's talk about returns for a minute. Historically, we had a really good run in financial markets. These are US numbers going back to the late 1800s, actually. And look at those numbers. Equities, this is net real returns, 6.7% per year. Bonds, 3% per year. So 60-40 gives you 5% plus real. And in some situations, those assumptions are still being used to look at forward costs. And I and many other people argue that's just fundamentally wrong. And you will hugely underestimate the cost of future pensions if you do that. And I use the simple, actually Neumeier and Gordon, the Gordon model, very simple forward-looking return model where you basically, R equals Y plus G. I guess that's three things again, isn't it? R equals Y plus G, where Y is the current yield and G is the growth, the real growth in that yield over time, or in the, if you like, the income stream over time. And if you do that today, I did it for the S&P 500 recently, you end up with 2.1% for yield, and I use a conservative 1.5% for G going forward today. So if you add those two numbers together, you don't get 5 or 6. You get more like 3.5, right? And then, well, I mean, the switch, you know all about where real bond returns are these days. At least on our side of the ocean, they're still positive. 50 basis points maybe. You're in a somewhat different situation here. So if you start using those numbers, you end up with forward-looking return expectation, maybe half of what historically we've been used to. And then the question becomes, what does that do to the economics of workplace pension plans? Well, if you want the same target pension, they become twice as expensive. And then the question becomes, well, that's not affordable. What do you do? And again, three things come to mind. One is a certainty that, you can all write this down, we're all going to work longer. I mean, this notion of the historical retirement age, throw it out the window. It's not reality anymore going forward. So you can have your argument if you've got a national retirement date, 65, think 67, think 70. So that's number one. Number two, and this is kind of a very sober thought, we can have shorter retirement periods from a longevity point of view, but that's not a very attractive one. In fact, the history is not that we've been living shorter periods in retirement, but longer periods in retirement. So dying sooner is not a great option either. And that leaves you with what? It leaves you with what can we do on the investment side, right? And so the final thing I'll do is I'll leave you with some of my thoughts on what's possible on the investment side. And so remember, the one thing that I remembered from my academic days was John Maynard Keynes was a really cool guy. And he was not only a great economist, but he's a very interesting individual. And I learned later on that he actually ran the Cambridge University Endowment Fund from 1921 until 1946. So he was actually an investor. And if you go back and reread, I'm sure you've all read The General Theory of Employment, Interest, and Money, which was his famous opus in 1936 on how to solve depressions. He had one chapter in the book on investing. And it's probably the best thing that's ever been written on investing. And I found out later the reason that he was so close to it because he was actually, if you like, an institutional investor himself. And what he did was to make this distinction between what he called in chapter 12 speculation and investing. The term that he used for speculation was beauty contest investing, which was the whole notion of trying to figure out which securities the market would think most beautiful six months from now, and you buy them first. And then you sell them 6 months later, and you repeat and repeat and repeat. So you can have a choice. You can call it beauty contest investing, or you can call it speculation. Keynes didn't distinguish much between the two terms. And frankly, I have to tell you, when I walked into the Sun Life investment world in '69 and observed institutional investing through the 70s and then 80s, 90s, a lot of the actual behavior that I saw out there, even today, Keynes would call speculation, not investing. The only thing he said that's really investing is to take savings and turn them into wealth-producing capital. That's investing. And if you take that definition, the question becomes, does that matter? whether you take one definition or the other. Well, if you look at empirical research on speculation or short-term investments driven by short-termism, on average, they lose money in relation to the market. Predictably, I would argue. And then the question is, well, what about real investing the way Keynes would define it? Does it also lose money? And the answer is, well, no, you don't have that many observations where you really know that the money is being managed using Keynesian principles for a long period of time. But in those cases where we can find them, you get, in fact, significantly positive results. So I'm going to show you here a Harvard Business School study that just came out. And they simulated what Keynes would call investing. And what they did, I won't go into much of the details here, but they basically used two research sources. One is the, if I got the numbers, KLD. There are actually three people that started a ranking business back in the late 1980s and have been doing it ever since. They sold the business. It's now actually being done by a larger organization. But the whole idea is what they were ranking was the ability of companies to actually create long-term sustainability in their business model. So they didn't focus so much on the financial results as on the non-financial behavior of the management of the organization. And they ranked companies based on their assessment of how well the business was being run for long-term sustainability goals. And then the other organization, much more recent, SASB, is the Sustainable Financial Standards Board, Accounting Standards Board. And it was started by Michael Bloomberg less than 10 years ago, again with this notion that what companies should be reporting is on their sustainability long term. And one of the things they did was to say, well, sustainability, as to what are the drivers of sustainability, is not the same for every industry. And so they created a materiality ranking as to what the factors were that were really important in the resource industry versus the services industry versus the pharmaceutical industry, et cetera, et cetera. So what these Harvard Business School people did is they combined the two rating sets on, and you can see it here, on a very large database, 2,300 US stocks, and they did this for a long period of time. And they basically created portfolios based on those rankings. And if you look at the decile, where they basically took the top 10% in terms of rankings and the bottom 10% and then ran those through time, you can see a return differential that's really amazing. 9% per year return differential over a 25-year period. And to me, it's an indication that if you really take a Keynesian approach to investing, that it so happens not only are you making the world a better place, you're also generating higher financial returns for your clients. And then the next question, of course, is, well, what about the real world? This is just a paper study. Well, you've got to look hard to find organizations or people that have actually managed money using this philosophy for a long period of time. It's not a big sample. And here I've got Keynes, number one. There were some couple of professors at Cambridge University went back and got out the old files and actually recreated Keynes's performance as a money manager from 1921 to 1946. And guess what? He was market plus 5% per year. Buffett, we all know about Buffett. He's market plus 10% per year. But there's some other ones here that are actually more institutional. Mass Financial, who would have thought? They've actually had a long-term investment process that goes back to the late 1980s, and it's like 250 basis points per year. I've mentioned Ontario Teachers. They manage money this way, 220 basis points per year for 25 years. Generation Capital, anybody know who that is? Generation Capital? Yes. So originally these two guys got together. One was called Gore, and the other one was called Blood. And they thought, blood and gore investment management? I don't think so. And of course, that's Al Gore, David Blood. And they decided to call it Generation Investment Management instead. Again, index plus 5. And more recently, a couple of friends of mine used to run money for PGGM in the Netherlands, set it up as a separate business, ownership capital. And again, you put their record together, it's index plus 5. So it can be done in the real world, folks. But now we get back to the reality. And this comes out of chapter 12 of Keynes. And let's read it together. To do this over a long period of time, you need behavior that will seem eccentric, unconventional, and rash in the eyes of average opinion. And therefore, relatively few people will manage money this way, giving them a huge comparative advantage. And that's it. So, in summary, what the book says is that how you design retirement income systems is important. How you create organizations that manage the assets and look after the benefit administration, that's important. And how you invest retirement assets is important. And so I leave it there, Chris, in terms of, and we can leave this slide up, by the way, because this will be our agenda for our the discussion part of this session. So thank you very much.
Thank you very much, Keith. Can I please ask the panelists to come forward?
Oh, we got you an extra chair. We got you an extra chair.
All right. Excellent. So, I think we've heard quite a lot of different thought-provoking elements to discuss this, and we've put together a panel of experts who would reflect on what Keith's been saying from a Swiss perspective, from a Swiss institutional and specific Swiss pensions perspective. I'll just quickly introduce our panelists. We've already heard about Keith. First of all, let me start with Claude Chuard. Claude is an insurance mathematician and actuary by education. He started his own Chuard company, which will ring a bell with many of us, which has been taken over quite a couple of years ago, but Claude is still very active in the pension space. Today here, he'll be representing one whole aspect of the liability side of pension funds. Then Theodore Economou, CFA. Theodore is the former CEO of the Cell pension fund, the software now the president of the investment committee of the Lombard pension fund. And last but not least, Pascal Frei, also CFA charter holder. Pascal is a partner at PPC Metrics. We will explain to this audience who PPC Metrics is, of course. So that's a very important, very influential pensions consultancy in Switzerland. And I myself, brief introduction as well. I'm the CEO of CFA Switzerland. CFA Switzerland is the alumni organization of almost 3,000 CFA charter holders in Switzerland. Hopefully you'll be reaching that threshold this year in the year of our 20th anniversary as well from the society's perspective. So fingers crossed there. Now let's go into the discussion part. If I may ask you, Pascal, we've heard a lot about investing and investing in an eccentric, unconventional, rash way that we've seen. Thank you. It seems to me, looking at how Swiss pension funds are actually doing their investment business, is quite the opposite. It's very different. It's very much focused on liquid markets. How do you perceive that aspect, basically, of the behavior of Swiss funds relative to that long-term perspective? Is the focus on the beauty contest aspect? I'm not mentioning speculation here, of course. Is that focus on the beauty contest aspect of investment of pension fund? Isn't that a model risk per se for the whole system?
I would say, to answer your first question, is concerning investing from an eccentric point of view or in an eccentric way. I don't think that it's the right word to describe Swiss pension fund, but I don't know what is the definition of eccentric in this presentation. But what I would say is that pension funds tend to invest wisely in an easiest way, meaning plenty of passive or indexing in the main asset classes, equity, bonds, some exposure to real estate, and of course a little bit of other products like private equity, hedge funds, the other alternatives. So I would say from the strategic point of view, I would say that pension funds are investing wisely. It tends to, the model has well done in the last 15 years. If we compare to the US system with the 60-40, the result is better. So less risk. I don't know what would be the right strategy for the future, but at least looking back in the last 10-15 years, the system has worked well. Now, concerning your question about risk management at beauty contest, are the pension fund looking for safety, for security? The system today is based on a Milesian system where it's not professional sitting on board of trustees, and obviously they need to delegate part of the work, of the operational work to external, can be consultant managers, actuarial people, real estate consultants. So of course one of the key way to select the right partner is to do a beauty contest, to look at the market and to try to pick up the firm which is the best fit for the pension fund. And it can be the bank A in one case, the bank B in another case. This depends on the board of trustees and of course on more objective variables like fees, competency, etc., etc.
Keith, feel free to pitch in if you've got comments on that.
Well, maybe we should use the word rash, because just to put it out there, what I'm suggesting, if that your workplace pension system in Switzerland, instead of having, how many different plans do you have? If you had 20 rather than 2,000, you would be able to generate considerably more value for money than you're currently doing. And that's a reality both in logic and in empirical justification. So that's what I'm suggesting. It's not going to happen tomorrow, but you can't just look back. You have to use logic, and you have to look at alternative systems. And that's what my book is about.
Okay, thank you. Claude, from the actuarial perspective, I think much of the problems that we are seeing here today with regards to the affordability of pensions as well is due to the fact that too much promises have been given of pensions that were seen to be affordable with the legitimacy given to them by actuaries eventually, your colleagues. Two things.
how can we prevent that from happening again, that actuaries allow promises to be given without recourse to the really long-term affordability? And second, why do you think the responsible people don't listen nowadays anymore, now that, that many actuaries are actually warning of the long-term affordability and the impact that that has?
Well, thank you, Chris. A lot of questions, fundamental questions. I don't know if I remember all the questions. Now, as you know, I'm actuary, and what you said at the beginning, you were at the floor of the investors, and then you went up or down, I don't know, to the floor of the actuaries, and you see that there were two different worlds. And personally, I think you're quite right. The asset specialists do not very well understand the liability side, and I'm specialist of the liability side. We do not know too much about the investment side. This is very unhappy because I think if you would have a real connection between the two fields, it would be much more efficient. Now, I think we have enough time. I would like to say a few words. The general subject of this part of the seminar is what happens the next 20 years with our systems. Now, 20 years. Nobody can predict how it is. You can guess, you can be right or wrong. But I would like to look backwards 20 years to see what happened, or two major things that impressed me. Werner, you said that your introduction, we, the EZS, went 1999 to a study. I traveled to Boston to ask the very simple question, what is the internet able to do for pension funds? Because we did not have a clue about that. So this was very interesting. The internet did just start, but we couldn't understand what the value of the internet will be. Think of today, without the internet, even the pension funds are unthinkable. Another example is, sorry, I have it in my pocket. This year, this kind of device, 10 years ago, it did not exist. It was 2007 when the first smartphones went on the market. Today, the world is unthinkable. If you go into a train or so, 50% of the people are just looking at their smartphone. So things 20 years ago or even 10 years ago we did not even know about them are today standard, and it's unthinkable to not to be able to use those devices. Now, if we look ahead 10 years or 20 years, we will have fundamental changes we do not know about it today. So that's an important remark about guessing the future. Mm-hmm. Now, to your question, perhaps we take one after the other. One I remember is, why do the actuaries make promises that are for the future that are not realistic? I think.
Well, it's not the actuaries making the promises, but the pension funds themselves, based on on the legitimacy, on the reasoning that actuaries provide.
Yeah, I think actuaries can quite well make their calculations, their valuations. There are a lot of different methods. Personally, I worked for a very long time on the field, and I think if you look to the past, we had a static way of looking at things. We did not project in a dynamic way the future. And another event that happened for me, it's unbelievable, or I cannot understand that money has no value. At least here in Switzerland, even negative value. So two very important subjects in our evaluations are the longevity and the return on investment. And I have to say that today, the longevity. There are statistics since 1600, in England, John Brown in England. There are through a lot of numbers, historic values, and then the pension fund for the public Publica, Dieter Stoller, who is sitting here, they published their statistics since 1921, nearly all 10 years. And we see all the curves of the survival are one above the other. They never cross, so you never have a negative evolution of longevity. It always goes on and on and on and on and on. And if you assume for the future that this development will continue the same way, you have to consider this in your calculations.
And actuaries have always been slow to take that into consideration.
I don't think
right?
they have been slow, but we have another layer of problems. We have our lawmaker, and those are politicians. And politicians, they are not very eager to if I'm not quite nice to them, to say the truth. They like to make nice stories, and it's unpopular to say, well, you have to work longer, you have to pay more, and you will get less benefits. That's the truth. How do we cope with that? This is very important question that the politicians have to answer.
Yeah. We see that every day. Keith, you want to
so one of my big things in the book, and I write 4 pages a month. The letter that just went out to my clients is called "Can Actuaries Innovate?" ? And I argue that the record says that they're not very good at it. And for example, in the last 40 or 50 years, a number of, I think, key ideas have come into the mainstream. Behavioral economics, for example, where does that fit in? The life cycle theory of personal finance, where does that fit in? The Tinbergen notion, and that this is, let me just generalize that, is that a lot of the discussion here is happening in the context of you're trying to do two things with one instrument. Mm-hmm. It's fundamentally impossible. And we need to talk about the difficulty of moving away from the one instrument to two instruments. So there are a number of things that should be part of the general discussion, should have been part of the general discussion 10, 20 years ago, and we're still stuck. And my question is, how do we get unstuck and move forward?
Mm-hmm. And much of that being stuck is actually a fact that the theory of pension funds, of pension fund design 20, 30 years back has now gone into the code, the legal code,
That's right.
and cannot be changed anymore because of vested interests.
Well, actually, what's interesting, if you look to a country not too far from here, where I was actually born, Netherlands, they're working very hard of figuring out of how to unscramble, their one instrument problem. Mm-hmm. And to move to two instruments. So, there's a dynamic process going on in the Netherlands of trying to figure out of how to take their €1 trillion plus pool of assets and, in fact, allocate it separately into return compounding instruments and payment safety instruments. So it is happening. The Australians have got it easy because they've just historically run a DC plan, and they now realize, because their plan members have now accumulated values of $300,000, $400,000, $500,000, $600,000. And now the question is, what do these retirees do with this lump sum of money? And the answer, of course, is to create longevity products that allow that money to last for life. So there are examples of innovation going on, and we just all need to be part of it.
Mm-hmm. Okay. Theodore, you've designed a pension fund, or you were working in a pension fund in your previous responsibility that was quite unusual in that it's an international organization. It wasn't subject to Swiss regulation. Now you're coming into, and by the way, many say that the design of that pension fund was more akin to a hedge fund rather than a traditional pension fund. That may seem a bit rash, to put it that way, in the word here. But how do you cope with working in the context of Swiss pension fund regulation with your fund nowadays? How's that investing behavior that we've just heard? How's that turning out?
Thank you very much, Chris. I guess we're all the results of our experiences, and as you mentioned, my experience spans quite a bit of time in the US, working for a large pension fund there. I'm still on the invest committee of the Virginia retirement system, working in intergovernmental organizations, so in a different environment. I've been a trustee on UK pension fund also, which is yet another type of environment, and now chairing the invest committee of the Lombardier pension fund. So we're all obviously influenced by our experiences, but I think there's a couple of things that are remarkable about the Swiss environment. The first one is it's been tremendously successful, and I think we have to recognize that. It's created enormous value for the participants, the members, and it's done it with an approach that's been, and I'll pick some words from Professor Ambachtsheer, it's been very simple, right? And it's worked. So the question is, however, and that's another point I think that Keith shared with us, is to adapt the pension fund or its components to the particular situation, whether it's the environment or the particular actuarial situation. In the case of CERN, you had a pension fund that mathematically was going to run out of funds in 20 years, right? The funds were going to, that was my first presentation to the nations there, and it's a lot of fun. It's like speaking of the United Nations. You have the countries, Austria arranged alphabetically in front of you, and there's 21 countries, and I just show them a very simple actuarial projection, not of the funded status, but of the cash. How much money would there be? And there would be none left in 20 years. 30 years if the performance was excellent, right? So that was a wake-up call. And again, you got to adapt the instruments to the situation. In this particular case, the feedback collectively from 20 member countries was, do what you need to do so we don't lose money and we survive. Right?
I think we've heard whatever it takes before. Huh?
Whatever it takes so you don't lose money and you survive. Mm-hmm. And so the emphasis was to be actually more conservative. The policy had been. Now, and I'll talk about this later, one of the implications in the current environment of being more conservative is actually being less traditional. And I think that's what generates some reactions. But the mandate there was very, very clear. Don't lose money, right? Now, is this optimal? That's a different question. The point is that was the mandate. Leading to that, and your second point about the Swiss perspective, I mean, listening to Keith, I'm taking away three things from Keith. I'm going to stick to the three things theme. The first one is that a lot of what Keith shared with us was, for the last 20 years, optional. In other words, it was not necessary to reach your objective. What it led to, and I think Canada is a good example for it, having applied this framework, it led to overperformance. But it was more than enough to than reaching the objective. The point, however, is that today, and the first measure I took, what was optional in the past is essential in the future. In other words, we need all the marginal improvements in governance, in investment, in design, not wholesale changes, marginal improvements. Why? Because today we are in a zero or negative interest rate environment and yield environment. So it's a new world, right? And so that's the first message I take. The second message I take is the importance of advisors. I think one of the reasons the system here has been so successful has been blessed with very high quality advisors. And the resources, therefore, to me, while the scale is not here, as Keith said, the resource in terms of advisors that can bring the scale is here, and we have many in this room, right? So that's the second point. And the third point I take is how practical what Keith shared with us is. In other words, what I'm taking from it, and I've done it with every pension fund I've been involved, is put these three questions, typically the last two, because the design question is one that there's little leeway about, but the last two, and organize a series of off-site board meetings, investment committee meetings on these questions, bringing in the advisors. Don't talk about the performance, don't talk about the regular business, don't talk about the next asset class or the manager we want to hire and fire. Just discuss these questions with the advisors. It's tremendous. It makes something very easy to do after the presentation we heard. So this is the three things I take.
Okay. By the way, if there's questions in the room, please hold up your hand and I'll come to you. Elko.
Thank you, Chris. Keith, I was triggered by your remark about the smaller funds, the more agents you have, the less value for money. Maybe something that the panel can also chip into. What does this mean for fiduciary duty of the pension fund trustees and other board members, having this notion of more agent, less value for money? Thank you.
Well, it really raises a very touchy point that I think is worth asking and worth talking about. And in this board effectiveness program that we run, one of the topics is fiduciary duty. And it's an interesting evolving concept as to what constitutes fiduciary duty. But the essence of it is that you act in the interest of whoever the risk bearers are, the stakeholders in whatever situation you're involved with, and that you're able to do a 360 all the way around to ensure that whatever decisions you make are somehow knowledgeable and balanced, taking into account the various interests. So, that's the notion of fiduciary duty. And in an ideal world, and I recognize the world's not always ideal, you actually have a board that understands the concept and has the capability of actually doing the kind of things that need to be done in terms of questions that actually, where you can demonstrate that you're exercising fiduciary duty. And so logically, if you can put all the pieces together, you do end up with a Drucker-type pension organization that has all of those things. How close is second best? Well, if we can create fiduciary structures that use advisors in a fiduciary sense, then arguably you can get quite close to the optimal. But then it does become the question is, how do we know that these intermediaries dealing with an asymmetric information challenge, what do they bring to the table? Is it really the best interest of? And so that's the question. And some of the research that I've seen on fiduciary management, actually the results are pretty good. So I'm not saying it can't be done. I'm just saying you have to understand the issues. And the other thing, and I'll just ask everybody in the room here, you talk about the Swiss pension system having performed very well. And so immediately I think, okay, so is that a value for money measurement? Because if you're telling me that you've been long bonds, I know long bonds have done well the last 10 years, and I would say, so what? Unless you actually made a market call. And it so happens that, if you've been basically taking LDI, balance sheet risk off the table, that's worked very well the last 10 years. But that doesn't answer the question today going forward as to, we know that looking forward, these returns in real terms are close to zero if you're on the long or even anywhere on the yield curve. And the question now becomes, what can you do to create wealth going forward today? Will the current structures work? And I'm suggesting they need to be looked at, because I argue you need a more entrepreneurial approach to investing to get in there, engage in the wealth creation process. And my question is the Swiss system capable of doing that?
Other comments?
I mean, about the size of the market or the average size of pension funds, I think it's not the current economic environment who is killing the funds, but it's the complexity of regulation. Like the new regulation on divorce, for example, you can have a very good board of trustees. We are touching questions which are too complicated for unprofessional people. The current environment, low interest rates, longevity, everyone is understanding this. But this regulation, which is very more and more complicated, is killing the diversity of pension funds, is forcing pension funds to go to collective foundations. And yes, that's the issue. Now on the size, it's interesting, and it's not only PPC metrics, statistics. I think UBS is also producing the same. If you look at the size of the pension fund and the success in terms of performance, what is interesting, it's not the largest which are the best. It's more the middle or the small one. So size is definitely a very important point. We will go in direction less pension funds and larger size, but there are also additional risk with larger pension funds, especially for Switzerland. We were preparing this conference speaking about 200 billion pension fund. I don't see 4 pension funds in Switzerland. I don't think it matches with the philosophy and the way this country is working. So we have to find, like every time, the right balance between bigger pension fund and diversification.
Well, maybe I'll be a bit cheeky here, but maybe it's if the system or the size of pension funds don't match the Swiss way of thinking, maybe it's time to actually question that way of thinking.
Yeah, I mean, look at what is what people are speaking about the first pillar, about Compen Suisse. Everyone has an opinion. Some people are unhappy. Some people are happy. Then politicians are taking their responsibility and try to regulate more and more. I'm not sure it's good for our first pillar if there is more and more regulation, especially in terms of investment or investment universe. So. Having more smaller investors gives more flexibility, and in my view, that's a good model. Look at this private equity or this initiative to ask a Swiss pension fund to be forced to invest in private equity. I don't think it's a good idea.
Well, we'll talk about that in the next workshop for sure, about the different ways in which you can invest in private markets, of course. But I would like to go into a bit more into that discussion about exactly the scale on the one hand side and representativeness and the advantages of scale. You mentioned your statistics and the UBS statistics. We've got Sven. Where are you? Sven here as well, representative from our sponsor UBS. The fact is, these statistics are basically looking at the Swiss population of pension funds, which has a certain structure and regulation, but they're not looking at the global population of pension funds. So it would be really interesting to match that across the different systems as well, and take into consideration the different categories of very large-scale pension funds as well, and see whether maybe in that context, in the investment model that Keith has been outlining, whether that statement of yours still holds. And I'm not sure whether statistics like that are really available. Keith, do you know more about that?
They are available, but not generally on the marketplace. I mentioned CEM benchmarking. It went into business in 1991. So it now has a database that starts in 1991 until last year. It's about 25 years. Cross-sectionally, it's got, I don't know how many Swiss, I don't know how many Swiss participants there are in the 400 funds that participate, very few. But what I can tell you is based on that database, one of the requirements is that every fund has to provide a reference portfolio, which is if it implemented its policy passively, this is what we would do. So you need to have that as part of the system. So you have a reference, very low cost policy implementation mechanism as the benchmark. And then the question is, both gross and net of costs, what is the fund actually producing, right? I mean, that's a clear value for money measurement. And in the whole database, I can tell you that on average, over periods of 10 years, continuous data or longer, because you need to look at it for a long period of time to make it, otherwise it's just noise. The average, it is a positive net excess return of about 15 basis points in the database. So it is positive, and if you relate that, for example, to a large portfolio collection of retail mutual funds, their average performance for 10 years or more is minus 300 basis points. So immediately, I mean, this is what I was saying in the difference between Pillar 3 and Pillar 2. There's a huge advantage to being in Pillar 2 rather than Pillar 3 for the average participant. But then if you look inside that workplace pension plan universe, and you look at what are the drivers of performance, then scale comes out a statistically positive element. And then when you look within scale, the funds that are really driving the excess returns are the ones who have internalized private markets investing. If you outsource private markets investing, you're quite right. If you're a small fund, you're up against a very, very large hurdle, 2% base fee, 20% carry. There's a third level of cost that never gets mentioned, of transactions that happen almost in secret. And if you add up all the pieces together, it works out to about 500 basis points per year cost. Well, if you create a 500 basis point hurdle, guess what? The average swell fund is going to lose, not win. If you're a large fund and you're capable of actually attracting and insourcing people who can do private markets investing directly on your own account, now you're not spending 500 basis points. Now you're spending a great deal less. And guess what? It's those funds that are the best performance in the database. And they happen to be largely Canadian because we went to a model where we put no constraints on compensation inside the pension fund. So we now have a lot of investment bankers who switch their black hats for white hats. That's a cowboy analogy. And are now working inside pension organizations, generating very significant excess returns net of costs. But that's the scale I'm talking about, and that's the scale you've chosen not to participate in Switzerland. And I'm just putting it out there. It is an option. Maybe you don't want to take the option, but it's an option.
Claude.
Yeah, just a remark on scale. When I started my work as an actuary, it was a long time ago, 1970. And there were more or less 20,000 pension funds at that time. Now there are 2,000. I think this is still much, much too much. Pascal said that the reasons why it's shrinking, I think it's all the legal constraints, which are extremely complicated. It's the actuarial problems, longevity, and returns on investment. I think this forces the number of pension funds to shrink. I think it's still much too high. And we have somebody here from Austria. Wie heißt der? Yanda, Mr. Yanda. We, from the EZS, we made a study trip to Austria, and they presented their system. Austria is not very far from Switzerland. It's border to border. And Mr. Yanda, I don't remember, but you said at that hour, or somebody said, you had only 15 pension funds in Austria. Am I right or wrong?
13 these days.
13. So you see, there are in fact other ways for people that have more or less the same culture to go a completely different way. And I wonder, perhaps Mr. Yandia, you could give say one or two words to the efficiency and to the size and the scale of the pension funds in your country. Would you? Yeah, would be nice to say.
Thank you very much.
I'm the managing director of the Austrian pension fund industry. We have 6 multi-employer pension funds. The rest are single-employer pension funds. The multi-employer pension funds are daughters of banks and insurance companies, and the single-employer pension funds are related to companies like IBM, like Porsche, like to the civil services of the state. We have 20 billion of investment sum, and nearly 25% of the working population in Austria is in these funds. The return of the pension funds for the stockholders is very low. The single employer pension funds make no profit. We had in 15 years ago 25 pension funds. Why we have so less in these days? The reason is the mergers by the bank and insurance company on the one hand side. On the other hand side, by the single employer pension funds, is in these days it is not so sexy to have an open pension fund. The multi came back to their kern business. When I make a step before to the next topic, one of the reasons that we have such so less pension funds in Austria is the regulation. We have a lot of regulation of our government and more regulations coming from Frankfurt, from IOPA, and so it's very hard for the staff to make to view all these regulations. Thank you very much.
Thank you, Mr. Ender.
I could also mention I had a visit in Toronto from the board of Electa, which is the Swedish pension fund for all white-collar workers in Sweden. It's another example of having a very large pension fund service a large part of the labor population in Sweden. So in that case, I think there were 2 million members, well over 100 billion euros in assets. So yeah, large funds can exist in a small country.
So it's perhaps also a case of obviously the Swiss pension fund system has been put into law in 1985. So it's a while, shall we say, and the system has.
That's true, the basic law, but the first pension funds
they're much older.
No, is 1818.
Yeah. Yep. I think you've written a book on the system, right? Thank you for that correction. So basically, the putting into the law is the aspect that I was actually focusing on, and that's I think the regulatory context is really what's the clincher here. What will make the huge difference when it comes to the further consolidation move?
So maybe we need Einstein, and maybe we can have big placards in front of your parliament with the Einstein saying, "Make things as simple as possible, but no simpler."
Yep, that's certainly a challenge to many politicians in that way. Well, we're actually very soon running out of time here, so I would like to basically open to one more question from the audience, if there is actually one, and.
Keith, good afternoon. I just want to touch briefly on the investment side. You mentioned 2 companies, Ownership Capital and Generation,
yes.
Which I know are based on the integration of traditional and non-traditional information. I just would like you to sort of expand briefly on that, because you said that they are overperforming compared to the benchmark.
The way that I've characterized what's different, and this notion of what Keynes called rash, unconventional, is that when you change time horizon and you go from short term, I mean, everybody says they're long term, okay, but you don't pay any attention to that. You actually see what people do. And the truly long horizon investors don't focus on capital value changes. They focus on the underlying sustainability of the underlying cash flows. So when they analyze a company, and a classic example is Unilever, they would basically look at the dividend stream that Unilever produces today, historically, but also what's the plan for 10, 20 years from now of how Unilever sees itself operating as a company. What kind of things are they doing to sustain that growth rate in the dividend? And in the case of Unilever, it's a very good story, I believe. It ranks very high as a sustainable company. As opposed to, for example, if you look at the whole high carbon energy sector, and you look at the sustainability of its cash flow, I would argue it's questionable as to what that cash flow is going to be 10, 20 years from now. So that's just a simple example of the kind of thinking that these long horizon, what I call Keynesian wealth producing investors, what they do. The other thing they do is they actually understand enough about the management of the organization to have a view as to whether it's being managed in a way for the best interest of its stakeholders. So that's the fundamental difference. They're not trading, they're basically, I'll give you another example. Two Canadian funds are funding a toll road around Mexico City. What do? You basically look at the economics, you look at the political situation, you look at the protection you have, the cash flow that you're buying, and its ability to grow. So these are the kind of things that long horizon investors think about, and they don't worry about an announcement. In fact, Unilever is a classic example where they don't provide earnings guidance anymore on a quarterly basis, because they're basically saying it's noise, it's irrelevant. We don't do that. Most of the companies still do it. They're still playing the old game.
Theodore.
Thank you. I'd like to make one comment, perhaps, because we're Swiss, and the Swiss way is very much about compromise and the middle way. And so we've heard about two bookends here. One bookend, a system that still has, how many, 2,000 pension funds today? And another system that has 15. In Canada, there's about a dozen, I think, or less. Is it possible, and clearly the Canadian model seems unrealistic from a perspective, local perspective in the long term. So is it possible what can be done in the short term? So I have two things that I think merit examination. The first one is, even though the Swiss legislation is prescriptive and very prescriptive, it does leave quite a bit of leeway to apply some of the principles that were shared. So our own pension fund has an allocation of 4 to 5% to generation capital, okay, in global equities. So you can do it, right? Nothing prevents you. And fixed income, nothing prevents you from having a different bond selection process and having a buy and maintain strategy. The law does not oppose it. So there are things you can do that actually can help improve and go in this direction of what very large pension funds do. The second point I'd make, and here tainted my own experience, the large pension fund I've been actively, closely involved with is the pension fund of the state of Virginia, which is about $70 billion. It's among the 50 top largest in the world. And just to give some perspective, even VRS, as it's called for short, while it has internalized large parts, such as all fixed income, in areas such as private equity, in areas such as infrastructure, it has what it calls strategic partnerships. In other words, it recognizes that even at 70 billion, it does not have the scale to fully insource highly complex skill set, and instead chose a middle way by choosing external partners. But by choosing a few, and thanks to its size, it's able to negotiate pricing down, and yet at the same time develop a symbiotic relationship. And so these are two thoughts that I wanted to share, perhaps to make the discussion more tangible and give some avenues of thought for this audience.
And you will have the opportunity of seeing more detail about how the pension fund of Lombardier is actually invested in that category in the workshop that it will be following right after. So basically, if I can summarize, and just looking at the clock, we're going back into the usual time frame now, or into the planned time frame now. It seems to me that that regulation is having a huge driving impact on the speed of the consolidation of the Swiss pension sector. We've heard that from a couple of aspects. It's not so much apparently the logic, the business logic, apparently from what our speakers have been saying, but it's really the consolidation pressure that's coming out of regulation, the understanding of how that actually drives the decision making, the complexity. Now, we've had an example for that before, and that's farming. The Swiss farm sector was, when it was for the first time exposed to international markets, there was a huge pressure on to consolidate, and the federal administration that supported farming basically put a growth, or effectively an effective shrinkage target on the number of farms, a consolidation target on the number of farms, and the linkage really comes from comparing or being exposed to the international market for food, in that case, in the farming. In Switzerland, it seems to me that there is obviously no such exposure, but maybe we should actually really think outside of our Swiss box and outside of just the Swiss system, really looking at the experiences that other pension funds, other pension systems are making all over the world, and also take into consideration scale effects, for instance, that are at play outside of the Swiss system. So that purely domestic view, I think, gives us a very distorted picture of what realities are. So that's basically my key takeaway from Keith's presentation, from the conversations that we've had. But in respecting the rule of three, obviously, there's got to be more than that. And I've asked our panelists each to come up with one of their key, with just one. But we've got three panelists. Just one key takeaway from the discussion and the presentation that we've heard here. So maybe, Claude, can I start with you? What's your key takeaway from the presentation?
Well, I would say I'm a little bit concerned about our pension reform. That's Swiss problem, pension reform 2020. I think we do not say the truth there for the future development. We plan the past and not the future.
Thank you.
Thank you. My takeaway is both a concern and an avenue for discussion. The first one is that the situation in which the Swiss pension system finds itself, as was just described, needs action. However, that discussion so far has only focused on two aspects, contributions and pensions. What I take from the presentation is that investment policy is a third lever that should be looked at and should be used to the maximum. And we were offered avenues on how to examine that.
Very crucial aspect. Thank you. Pascal.
I mean, I joined the opinion of my colleagues, but what I would like also to add is that the second pillar in Switzerland is the old pension system in Switzerland is very good. We have to reform it. We have to think more real and less nominal, and then explain the population that the system will pay you pension maybe 2/3 of what we promised, but it's still the best system we can have in terms of for the future. As Keith said, the second pillar is obviously much better than the third one, and we are here speaking about the first and the second, so reform the system, think real, we will get less, but it's still the best system.
Thank you. Keith, the last word is to the keynote speaker.
Well, you're number 5. So the one way to have the discussion is how do you move to number 4, number 3, number 2? And I think that gets you back to this notion of integrating across the design issues and the organizational structures and the investment policies. That isn't just one thing. It is, in fact, the integration of those 3 things. And hopefully that message has been, I think, has been very well discussed this morning. And so I leave you with that thought. And don't forget Einstein. Keep it simple.
Thank you very much.